thanks. When Fed Chair Jay Powell came to the job in 2018 as the first non-economist chair since Paul Volcker in the 80s, he expressed respect for economists and economics, but skepticism. His biggest beef, how key economic theories didn't work so well in practice. Ideas like the neutral interest rate, or R star, kept changing. Unlike celestial stars, he said in his speech last year at Jackson Hole, these stars move unpredictably and cannot be directly observed. The historic change to average inflation targeting announced yesterday by the Fed came after 15 Fed listening events, and it reflects the unanimous approval of all 17 members of the Federal Market Committee. But it's also the result of the evolution of Powell. The Fed implemented inflation targeting in 2012 under then Chairman Ben Bernanke, a leading monetary policy expert. But over time, Powell began to see an inherent flaw. The public will always anticipate rate hikes once inflation moves towards the target. So you never hit the target. The Fed was really chasing its tail by moving to average inflation targeting. Powell and the Fed are hoping to try to convince the public that inflation can rise to the target and above it in order to average 2% over time. The other big change announced yesterday also reflects Powell's observation of how economic theory can fall short in action. The Fed kept waiting for low unemployment to spark inflation, but the rate kept falling, inflation kept not appearing, and yet Powell could see tremendous social gains from low unemployment. In this year's virtual Jackson Hole speech, he said the strong labor market that prevailed before the pandemic was generating employment opportunities for many Americans who in the past had not found jobs readily available, especially low-income Americans. Now, the Fed is going to let the economy run with low unemployment and worry about inflation when or if it really shows up. All that's part of the change of Powell from outsider to trailblazer. Now, Kelly, we wait to see what it means in practice and whether it's right.
But it's so fascinating, Steve, you're right, from an outsider to a trailblazer. And I don't think any of us would have thought at the time, this is going to be the guy who's trailblazing to a new, I mean, just because we could never have seen the nature of what he's confronting come, and they seem oddly to be matched well to one another. So let's talk about some of the risks, though. I mean, so far as we go through the pandemic, so good, but there are plenty of risks to his new strategies.
I think that's right, Kelly. I think I can get them all on one hand, which is sort of good news that it's only one hand, and bad news that it probably fills up all five, includes all five fingers. You have asset bubble problems. There's an assumption underneath it, Kelly, that they can address inflation when it comes. So those are the issues they're going to have to deal with. I think it's okay for a while. Also, questions about how to calibrate this idea. He said it wasn't a mathematical formula, so we kind of got to feel our way in figuring out what the Fed is going to do. There are definitely risks involved, but right now it seems like the better bet to let unemployment run lower and worry about inflation later.